Well, good morning. Welcome to the Common Sense Institute's Eggs in the Economy. My name is Kristin Strohm and I serve as President and CEO. I want to thank you all for joining us virtually this morning for an early Friday morning, but we have a lot of great information to cover and thank you for attending. For those of you that might not know what Eggs in the Economy is, it's a quarterly symposium where Common Sense Institute brings together community leaders, policymakers, and business leaders to discuss the most pressing public policy issues the state and you are facing. So welcome. Before we begin, I do want to offer just a moment of silence for the tragedy that happened up in Boulder. It's impacted our state greatly, our entire community. So if you could just join me with a moment of silence, I'd appreciate it. Thank you. For those of you that might not know too much about Common Sense Institute, we are a nonpartisan research institute dedicated to the protection and promotion of Colorado's economy. We focus on studying public policy issues that are hot topics in the state, ranging from legislative proposals to ballot initiatives. And we do that by employing dynamic econometric modeling. And we have a great team of fellows and economists that help us conduct this important work so that Coloradans have the facts when they're at the ballot box to vote. Policymakers have the facts on potential policy issues when they're proposing different pieces of legislation. Just a little bit about our work so far in 2021. You can see on this screen, we've actually released a dozen reports so far on issues ranging from jobs in the economy and the ongoing recovery from the pandemic, the she-cession that has plagued women in the workforce, Colorado's Unemployment Trust Fund, greenhouse gas, and then most recently, we've released a report on Colorado's competitiveness and what it looks like for our state in a post-pandemic recovery coming out. How can our state position ourselves to be the top once again? I'd like to share just a quick video on that report. All of these reports you can find at our website, www.commonsenseinstituteco.org. I'll put that in the chat as well so you have access to it. But join me in watching this quick video on our most recent work.
Well, the year of 2020 has thrown us a curveball,
especially for local businesses. As of February, small business revenue was down 29.5% from January 2020 levels. That's according to a new report released today by the Common Sense Institute.
Common Sense Institute of Colorado. Common Sense Institute.
Common Sense Institute.
The nonpartisan Common Sense Institute estimates new taxes and fees will cost businesses about $1.8 billion per year for the next 3 to 5 years.
They say state lawmakers have passed dozens of bills that will end up costing them.
No surprise that small businesses are most at risk here.
New numbers show just how bad this last year was for small businesses. Over 90,000 jobs were lost in the leisure and hospitality industries. It's a statistic affecting a majority of local businesses in our community.
Colorado es uno de los estados a nivel nacional en donde más se ha visto afectada la fuerza laboral femenina.
We need our state leaders to simply allow businesses to get back on their feet during this time, because that is the only path to economic recovery.
I don't think we want to watch that several times, but thanks for indulging us in watching this. I'd like to dive right into our topic today, which our first panel is going to be moderated and led by Joey Bunch, who is a 35-year reporting veteran, including 20 years in Colorado. He's the deputy managing editor, senior writer, and columnist for Colorado Politics. Plus, he's my favorite Alabama fan besides my husband, so roll tide. But before I turn it over to Joey, I just want to set a few housekeeping rules. We have a limited amount of time with our panelists. We're so thankful that they are willing to spend time with us this morning. Joey has some prepared questions for them. We're then hoping to allow about 10 minutes for audience Q&A. So if you do have a question throughout the discussion, please log that in the chat, and then I will facilitate those after they're done. In addition, we want to ensure that all the panelists have equal speaking time. So if panelists could keep your answers to about a minute and a half, that would be wonderful. We're going to dive into the hot topics today on what's going on down at the Capitol. Thrilled to be joined by 2 different legislators. And then we're also joined by our Vice President of Policy and Research, who Joey will introduce to take a really deep dive on the Colorado public option proposal. So with that, Joey, I shall turn it over to you.
Hey, good morning, everybody. It's great to see you again. You know, it just, in some ways, it seems like it was yesterday that we were all together talking about this in Denver. And, you know, here we are again talking about it again. The only difference is I was wearing shoes the last time, and today I'm wearing pajama bottoms, and I suspect most of you are as well. In fact, I told Kristin we should change this from eggs in the economy to pillow talk, but you know, she didn't go with it. So here we are. So good morning, everybody. We are lucky. We're talking about the same thing, but we're talking about a different thing. You know, we're talking to the father of the public options on both things, Dylan Roberts. He's Democrat from Avon, who I expect big things from in the future if he can survive the next couple of months. I think this has all aged him quite a bit. You know, on the Republican side, we've got Hugh McKean, and one of these days, people are going to invite me to speak at something Hugh's at, so I can tell the story about the time that Hugh kept me from getting my butt beat in a fight, and he doesn't even know the story, but you know, thanks a lot, Hugh. You know me a lot better now. Maybe you'd let it go on. I don't know. But one of these days, I'm going to tell that story. And, you know, most importantly, somebody I've really come to rely on a lot on this issue and others is Chris Brown, who's recently promoted to the Vice President of Policy and Research at the Common Sense Institute. Chris, among the many lessons Chris has taught me is don't pigeonhole people. I did a Q&A on Chris a couple of months ago, and I asked him this throwaway question: were you a better student or athlete in high school? And he said, well, I was a better athlete. Yeah, right. Chess is not a sport. Come to find out, this guy was not just a college athlete at a major college. He was an all-conference soccer player. So, you know, now I guess I can see it. Back then, I just saw him as, the guy I cheated off of in calculus in high school. But there you have it. So if you need somebody to cheat off of and somebody who can beat the other team at soccer, Chris Brown's your man. Let's jump right into these general economic questions. And since I owe Hugh a favor, I'm going to start with him. You know, Representative McKean, you know, what's the legislature doing to help people recover from this pandemic, both the health crisis and the economic crisis? What are we doing, and are we doing enough?
Well, you know, I'll start, and thank you, Joey, and thanks to the Common Sense Institute and everybody who decided to get up and sit in your pajama bottoms and do this. Please don't stand up, Joey. We would all appreciate that very much. No, I think that there are a couple of things, some you see and some you don't. I think part of what we are doing at the legislature is making sure that we get the business done of the people, but partly to keep pressure up so that we open the state, so that we look for those landmarks where we're hitting the right notes for the number of new cases and all of the things that we're looking for, so we can all step out of this contagion. But really too, it's provide that support for what the governor needs to do, for what we need to do to make sure that there's nothing slowing down the number of vaccinations that can be brought into the state. And that pipeline is just open. And, you know, we opened up in Loveland just a few days ago. We opened up a vaccination clinic run by FEMA. The goal here is to get people's lives back to normal so that they don't have to sit at 7:30 in the morning in their pajama bottoms in front of a computer screen. So no, I think that's a part of it. I think the other part is that back in December, Republicans were not happy. Let's just say not happy. By coming to the legislature for the special session and bringing a bunch of ideas and saying, well, actually, you know, we've already kind of got all the ideas that we want. And so it started a really good conversation with Speaker Garnett. And Alec and I talked about what is it that we that we need to do, and what do these ideas really bring to the table. And so that's what this session has brought, when we found that we had more money, and hadn't, all the big budget cuts last year had been really too deep. And so money came in, and about $700 million that needs to find its way out to the state. And the thing is that some of those things are just things we need to do. But the three buckets that they need to go into are putting people back to work, getting kids back in school, and making sure that we work on our infrastructure, our roads and bridges.
Well, Representative Roberts, you're in the majority and you're a shaper of opinion and influence in your caucus. What are the plans the rest of the session? What are Democrats going to do for us?
Well, thanks. And thanks for having me this morning. Good to see everybody. Yeah, I'll follow on right what Minority Leader McKean just was talking about. This stimulus package that was announced a couple weeks ago and now is in the drafting phase, where legislators are working on allocating that funding to specific things, I think is going to be the biggest thing that we do all session. So I'm really excited about that. $700 million coming from the state level is a significant amount of money. We're going to go to all of those three important buckets that Hugh just talked about: putting people back to work and helping business, getting kids safely back to school, and investing in our infrastructure. Just for example, I'm working on a bill that's going to create a incentive for people to book events and conferences in Colorado hotels and venues, and try to incentivize that event business to come back to all parts of our state. So that's just one example. There's going to be probably dozens of bills that are going to help business that way and help invest in our infrastructure. So by the time we're done, whenever that is, I think that will definitely be the biggest story out of this session.
Well, both of you mentioned this recent stimulus package from the state, but this is the second from the state, and the federal government has rolled out stimulus money as well. How is that money helping people, though? I know we can talk about government programs and spending, but Representative McKean, can you connect the money from the state house to my house? How is this going to affect vital programs like K-12 education and people getting back to work specifically?
I can connect it directly. And that's the thing, one of those grant programs or programs in the stimulus are the most grants, and making sure that there's enough money to go out there and help schools do what they need to do to make sure that kids can come back safely. We had this drive up in Thompson School District to put PVC pipe and plastic barriers between the desks. And so I went and helped a few people do that. But that's not really enough. We need to make sure that we've got all the things in place so that kids can go back to school and their parents can feel safe that they're there. But I'll tell you, one of the things that I've been pushing on in every meeting I have with the governor, I keep pushing on this. There are things that happened during COVID that we really, really have to take a look at. Unemployment Insurance Trust Fund is one of those. We're bankrupt by about $1.2 billion in the hole on the UI Trust Fund. And that, of course, was very much a function of not just policy before COVID, but during COVID, so many people were claiming unemployment because guess what? We shut the state down. And so we've got to do some things for that. And that does connect directly to your kitchen table. And it connects to every single family's kitchen table when they're sitting there trying to pay the bills and figure out, are we going to get a raise this year? Are we going to be able to do a little bit more? That is a kitchen table topic that I think is very, very common right now.
Yeah, Mike Tyson says everybody's got a plan until they get hit in the mouth. So let me ask Chris about that. Chris, as the state emerges from this pandemic, what's the outlook? What's the economic outlook for businesses and for average people like me?
Thanks, Joey. I think it's a great question. I think it's very hard to look at this pandemic and the outlook really in an average. And what we've seen through the pandemic is this wide range of impacts. It really depends on the nature of your business, where you are in the state. And so I think we have a real crisis for a lot of businesses in different industries, particularly hospitality and tourism. Still, 13% of the employment base that we saw just a year ago has not recovered. That's over 80,000 jobs. Whereas professional services, added jobs in January is near fully recovered. So we see a wide range of of impacts, but there remains immense uncertainty in the near term. You know, the federal dollars, state dollars will benefit some, but I think it's really a question of how quickly customers return, consumers return to travel, to areas of commerce, to shopping areas. But then we released a paper recently that also looked at the near term outlook, the next 3 to 5 years. And as Minority Leader McKean mentioned, we know that unemployment insurance taxes are going to increase by over 25%, nearly 25% a year for the next several years. We know that there will be several programs, including paid family leave, which will be implemented, you know, in the next couple of years, will have to be starting to be paid for without those benefits even accruing, as businesses that may be able to survive the next 6 months are trying to rehire and grow and expand. So I think, you know, overall, we are still in a very uncertain position, and it really depends on the type of, you know, work you're in, and so I think there's immense challenges ahead.
Well, you know, Representative Roberts, I want to ask you a follow-up on that, but then I want to stay with you as we shift to the public option. You know, my first question about economic conditions is, can Democrats maintain this momentum? I mean, Joe Biden has talked about building back better. Are Colorado Democrats committed to building back better? And I'm talking about things like infrastructure. Are we going to invest in the things that make us a prosperous state?
Absolutely. I think, you know, that phrase "building back better" is trickled down to the state level, and that's certainly a message that we are sticking to, and I think will be proven that we'll stay to that word with the stimulus package. That is a significant amount of money, certainly more than the state legislature typically has to invest directly through one-time funding. And yes, I mean, a third of that is going to go directly to infrastructure and transportation spending. So I think that's very important. Not only is that a great way to create jobs, but it's obviously something that our state needs desperately, with or without COVID. So yeah, I believe that we will have a comprehensive package, and we're going to be putting the dollars in the right places.
Well, I want to ask you a couple of healthcare questions. I'm going to put you on defense and let Hugh play offense here. You know, healthcare has been your priority. I consider you probably one of the, you know, the most informed healthcare experts at the Capitol. You know, has COVID changed the prescription at all? I mean, you know, why is it important that we pass the public option this year? And are the reasons different than they were last year before the pandemic?
Yeah, so absolutely. I think the short answer is yes. I think the pandemic shows why we need more affordable health insurance in Colorado now more than ever. And we need a more affordable health insurance option that is not tied to someone's employment now more than ever. Thousands of Coloradans, tens of thousands of Coloradans lost their jobs last year because of this pandemic, which meant they lost their health insurance. And to have no health insurance in the midst of a global health pandemic is not acceptable. And Chris just noted tourism, hospitality, those jobs aren't coming back right away. Those are my constituents. I represent Eagle County and Routt County. That's a majority of my economy. And those people are going without health insurance right now because they've lost their job. So yes, absolutely. We need to find a way to lower the cost of health insurance and give people a choice when they're shopping for that insurance. The big difference, though, that we'll probably talk about is that we've made significant changes to this bill to account for the pandemic and make sure that we're not rushing into anything, and to give the free market the opportunity to achieve those lower costs before public option ever comes online. So I think the pandemic certainly proves why we need more affordable health insurance now more than ever. But as a responsible lawmaker, we have taken steps to slow this all down and put in new features of that bill that I think are appropriate given everything that the healthcare industry has just gone through.
Well, Representative McKean, I know you to be a man of great compassion for other people. So I know that you want people to have health care and affordable health care. But how are Republicans going to get us there if this isn't the way?
I think that the first thing is understanding the nature of the problem. To Dylan's point, there are things that the pandemic has shown us, right? That there is this link between employment and insurance. We thought that some of that was taken care of with the Affordable Care Act. And so what we need to do is take a look at how that linkage works best, and how in unemployment and everything else, what is the look of that. But I think actually what we need tremendously in terms of changing one of the most dynamic sectors of our economy is how do you do this? You know, how do you come up with the percentage reductions in cost? And I know from talking to charge nurses that I'm very, very close with, that most of that money in healthcare right now is on the personnel side. And so how do we balance what you want to get, which is a reduction in cost? How do you balance that with the quality of care that you get? And I think that that's one of the more difficult moments in this bill, especially, is that the targets, when I talk to people in the healthcare industry, you know, a lot of people would love to be able to get to a 20% target for a reduction in cost. But I don't think that that's been fleshed out to the degree where we know where those come from, and we know what exactly it would be that hospitals and physicians and everybody else would have to do. The one thing that you know, physicians take the Hippocratic Oath, right? How does it start? First, do no harm. First, do no harm. And that means stop, take a look, take a listen, make sure. And as Representative Roberts said, you know, some of this bill pushes things out into the future, but it's going to make real change now, because there's going to be real choices to be made within the hospital system, within the physician system, within the insurance industry, of what it means to get to those targets and whether or not they're realistic at all.
Chris, you've lived with both of these bills. What's the difference between last year's bill and this year's bill? And then I'll see what the two representatives think of it.
Yeah, there's quite a few differences. I mean, what's interesting is when you consider the background of the starting point for the debate to begin with. You know, the bill has several significant differences, but you know, aside from a global pandemic and disruption to healthcare and the lingering uncertainty there, you know, the state has passed several major reforms within healthcare, particularly a reinsurance program that, on average, has brought down premiums in this year in the individual market by 21%. You know, as Representative Roberts mentioned in his district in Round County, you know, those reductions are 30%. You know, this in rates this year within the individual market. So we've seen significant changes in that baseline. And then as far as the legislation goes, I think the biggest difference is that it introduces a state authority, a state entity to actually sell and compete directly against insurance carriers in the event, you know, these targets are not met. And I will note that, you know, while it's a 20% reduction in premiums against 2021 levels, when you project out medical cost trends, you know, it's probably closer to requiring a 35% plus cut in those premiums in 2024 relative to where they would be. And it impacts the small group market, which does not have a reinsurance program. So I think it introduces a lot of questions about the state authority surrounding risk, surrounding costs, surrounding the different rules and mandates on providers to accept that. But ultimately, it really comes down to the same impacts that we've been, you know, talking about and trying to identify within our work for the last several years, which is when you use price mandates, when you use sort of government to set prices within the market. In this case, you're forcing providers to either cut costs or services in a way that impacts access or quality, or increase that cost shifting to increase costs to really the remaining commercial payers or large employers. And so we just released a report yesterday that estimated that to achieve those targets, we'd cut about up to $1 billion. And we think that's a conservative estimate with the erosion of other markets. But $1 billion would be shaved out of the system by cutting what we pay for care without really addressing the underlying cost pressures that drive those prices. And so, you know, when you look at that trade-off, it would lead to between 5,000 and 6,000 job loss within the healthcare sector, to passing those costs on to employers. And so, again, there's significant questions about the state authority and those lingering impacts that we've been discussing and trying to identify now for again, a year and a half.
Well, Representative Roberts, the one thing that last year's bill and this year's bill definitely has in common is you're the author of both. So what are the difference between the two? And, how do you respond to some of the problems Chris lays out?
Well, that could take me quite a while. I respectfully disagree with a lot of what was just said. And while I appreciate Chris's noting of Routt County's premiums going down recently, that's simply still not enough for people in my district. So people that I represent and people that I talk to, a family of 4, working hard, self-employed, or owns a small business, still paying over $40,000 a year just in monthly premiums to insure their kids and their wife and himself. That's unacceptable. That is not that is not affordable health insurance. And it's not fair that hardworking family in Western Routt County, I'm not talking about rich people in Vail, I'm not talking about rich people in Seaboat. These are working families in Hayden, in Oak Creek, in Gypsum, down in Eagle County, who cannot afford insurance, and their kids have health issues. And they cannot go to a hospital because they don't have insurance. So that's the problem we're trying to solve. We're talking about a public option. I see a lot of comments coming in the chat. This is not forcing anybody to buy anything. This is an option on the individual market and on the small group market that people can buy if they want to. And in total, we're talking about 15% of the state's insured population. About 8% of the state buys on the individual market, an additional 7% buy on the small group market. In total, 15% of our state is insured in these two markets. That's the only part of the market that this bill even touches. But second, I would say, we had this conversation last year. I was at this Eggs in the Economy. We had a bill hearing last year. All of these people come in and they say, we agree that healthcare is a problem. We agree that costs are too high, but this isn't the right way to do it. They never bring other options to the table. But what we did is we listened to them. We tried to figure out what we could possibly do. And so we built in a 2.5-year period that takes the healthcare industry at their word. They tell us that they can lower costs. They tell us that they can achieve cost savings. Just tell us what the goal is and let us do it without government intervention. I listened. I'm giving them that opportunity in this bill. They have 2.5 years to meet a voluntary goal to reduce prices on the individual and small group market. And if they can do that, then great. Then no public option ever comes online. And we can negotiate the 20% reduction. Everybody on this call works in business or owns a business, or how negotiation works. You start a bill out at a certain place and you expect to negotiate and meet somewhere in the middle. So I'm willing to have that conversation. We're already having that conversation. And I see people on this call who are in those conversations. But the healthcare industry tells us that they can lower prices. So we're taking them at their word with this bill. And I hope that phase 1 is successful. I think it can be. And we might never have a public option, and that's fine with me. I care about lowering health insurance costs so that my constituents and people all across rural Colorado, especially, but all parts of our state can have access to the security of health insurance for themselves, their families, or their small business.
Well, Representative McKean, how would you characterize this thing? Is it stick and carrot or stick and more stick? What do you make of it?
Well, I think that if we get down to the family level, I wake up every single day underwater. I wake up every single day knowing that I'm going to go to the legislature and I'm going to be 17 votes down. And so I look at things often from a what if perspective. And the what if perspective on this is, all right, so let's say that there's negotiation, but let's say that we also don't ever get to really a level where the private market can find those cost savings to get to an understanding of what affordability means between one person and another. Then I think that we really run the risk of doing something it's incredibly harmful to people in Colorado. And that is that we put their medical care, the people who, if we have a public option, if the public option is offered, likelihood that it will be the option that is most affordable. It will probably drive out some of the private insurers, if not many of the private insurers. And therefore, so then it becomes the option. And now people's health care is going to have to compete for dollars within the state budget with education and with transportation and with everything else that we do. And I've said this for years, that one of the things that we don't do well is we don't prioritize well. We don't have those long-term conversations where we say, look, here's where we need to go with education to fully fund it, to get rid of the BS factor and all of the other things we need to do. Here's what we need to do to fill the $5 billion hole in transportation. And here's what we can do to remain in fidelity with our voters and the citizens of the state. We don't do that well. And partly because there's so many competing interests down there that it just gets lost in the mix. But what I would suggest is that's the real risk here, is that the people who are paying a lot for healthcare today are getting good healthcare at a rate that everyone would like to see reduced and like to see options on the market. And that's the big thing, right? We had the co-op. The co-op went belly up, and all of a sudden a whole bunch of Coloradans were without any medical coverage at all. And so my concern is all of those unintended consequences that we march down the road toward. And like I said, I wake up every day knowing that I've got to go fight. As a lawyer in Loveland used to say, every day I got to kill what I eat. And the deal is that every day when I get up and I say, okay, what is it that's going to affect the family sitting down at their kitchen table looking at a stack of bills? And the problem is that the premiums are there, but so is everything else. And the more we mandate insurance to have to care for, the more we mandate certain things like family leave, like all these other things, the more we put that on our families, the more it is that they have tougher decisions to make.
Hey, Joey, I just got to jump in there.
I was going to ask.
There's a fundamental misunderstanding of what this bill is and what a public option even is. Public option is not government funded insurance, and it's not government controlled insurance. If you read the bill, it says that the phase 2 public option can only move forward if the state receives a federal waiver to innovate dollars that are already coming from the federal government to use to stand up this insurance entity. There is no general fund commitment from the state of Colorado to pay for this. It is paid for by the federal waiver and the people who purchase the plan through their monthly premiums. This is not free healthcare. Nobody's forced to buy it. It's just like any other insurance plan. You still have to pay a monthly premium. You still have a deductible. It is not free, and it is not paid for by the state of Colorado.
So I'm going to jump in there real quick, Joey, because here's the problem, is that we all know that if you're sitting around waiting for the federal government to do things in a consistent and ongoing basis, you will not only be frustrated, but you will be tired, cold, and hungry. And the problem is that when we say that well, we might be able to apply for this waiver, this bill does not say that. This bill says that upon its passage, the director of insurance will actually apply for that waiver. So this is not okay, we've got 2 years to maybe make this work out. The minute that this goes into law, and there's a safety clause in this bill, so that means the very second this is signed, then we are going to be applying for the federal waiver. And so that doesn't tell me that we're looking at, well, we're going to give the market a chance. Nope, we're going to go get a waiver. And that waiver is going to say, okay, we want those federal dollars to come in, but we also don't have the consistent knowledge of what those dollars mean. And we've seen it before. We've seen it before with other federal programs where we set our expectation at a level, and then we do have to fund it with general fund.
But the bill also says if we don't get the federal waiver, then the public option doesn't happen. And if we do get the federal waiver and phase 1 is successful, then those dollars go to an already existing fund to help people purchase cheaper private insurance. We've accounted for all of that, Hugh. Thank you.
I think our audience has questions to this effect, but I've done a terrible job of reading the chat. So, Kristin, will you help me out? And let's hear from the people that got up early. Who wants to ask a question?
Sure thing. Thanks, Joey. And this is such a great discussion. There are a lot of questions. And maybe Representative Roberts, you can start off by answering this one from one of the attendees. We know that rural Colorado hospitals take a big hit with the public option proposal. The CEOs of my rural hospitals in House District 64 are strongly opposed and want to opt out or waiver. How is this issue addressed?
Well, I'd say good morning to my friend, Representative Holtorf. And as a rural representative as well, I'll tell you that that's not true. The public option actually will help rural hospitals. And here's why. If we do move to a public option, so as no sooner than 2025, but could be longer or might not ever happen. But if we do, rural hospitals get a higher reimbursement rate from a public option insured patient than they do currently from a privately insured individual market patient. They'll get a higher reimbursement rate when that person comes through their doors. So they will make more money than they currently do. I would never introduce nor pass a bill that would hurt rural hospitals. As a rural representative myself, and somebody who's lived on the Western Slope my entire life, I would never do that. And I can assure you that this bill does not hurt rural hospitals. It helps rural hospitals.
Thank you. Let's go to another question, just so that we make sure that we get to all of our audience questions. How can the private sector compete with anything the government offers? They have unlimited money, unlimited power to force private companies to offer certain types of policies. Chris, do you maybe want to answer that one or kick it off? We can turn to everybody else.
Sure, I guess I'll try to address some of those questions there. And I think that this kind of gets to the one issue and one question that, the discussion around a public option and calling and discussing it as an option really raises when it's an option on the consumer side within the market. However, as I said, introducing the state authority with the rule of law to require all providers, so not just hospitals, but this is chiropractors, massage therapists, physicians, to accept the public option plan offered by the authority, or sort of threatened revoked of your license. That is a different set of rules that allow the state option to not build the network in the same way. As Representative Roberts also mentioned, the bill provides some leeway in setting prices for rural independent hospitals, but I frankly, trying to understand how you can increase what you pay providers and still bring down premiums for coverage. So I think that it is something we want to increase the dollars going to providers, to doctors, to physicians in rural parts of the state. And it's hard to see how that happens when the coverage, the premiums that are going to pay for those services are coming down. So a lot of questions on that competition side and the ability for private carriers to compete ultimately with, again, maybe a different set of rules.
Do either Representative Roberts or Leader McKean want to respond as well?
Well, I'd be glad to. So, we have laws in this country about the interaction between individuals who are buying a service and the people providing that service. In this instance, what we have is a structure by which the director of insurance will be the arbiter of everything. They will be able to create the rules. They will be able to enforce the rules. They will be able to set all of the structure of this from my reading of the bill. And I think that's just a really bad place to be. That's a very difficult place to have. Well, it's a place no one else has, to the point of networks. If what you do is you hold hostage the providers of healthcare by saying you will accept whatever prices and whatever fee structure we come up with, or you will be subject to the loss of your license, that's a power no one else has. All other insurance companies, when they set up their networks, they are negotiating what those rates ought to be. And in fact, I've said for years that everybody should own a health savings account, because it makes you an incredible consumer of healthcare. And the great thing is then you can go to your doctor and say, listen, if I pay you cash today or pay you from my debit card today, what's the rate for this? So you don't have to bill it. You don't have to put it back through your network. And often you find that that's where that latitude is. And so that's my biggest concern, is that when we put all that power in the hands of one person, now you have someone who is not an elected official, is not held accountable to the will of the voters and the people of Colorado. And instead what they do is say, here's what you get, take it.
Okay, a question for Representative Roberts. Can you respond to some analysis, I believe by Common Sense Institute, that the public option would not significantly reduce uninsured population?
Sure. So that analysis, I've certainly enjoyed reading CSI's analysis of certain things related to this bill. That analysis is based off of the state of Washington's public option, which is already in law. Our bill is absolutely nothing like the state of Washington's bill. In my opinion, the state of Washington's bill has some significant flaws that have made it so that there is not an adequate network of providers to accept the public option in Washington. So the public option is not available to most Washington residents. So that's why it hasn't reduced the uninsured rate. We did an independent third-party actuarial analysis of the bill last year and the proposal last year. That said that the public option would reduce the uninsured population by about 70,000 Coloradans. That's 70,000 Coloradans in the first year would have access to an affordable health insurance plan if that bill passed. So I disagree with CSI's analysis because it's not based off of Colorado's bill, it's based off of Washington's bill, and our bill is absolutely nothing like the state of Washington's law and now public option.
Chris, did you want to respond on your analysis?
Sure. Yeah, I'd be happy to comment. I mean, I think, you know, if we look at last year's bill, and I understand it's different and we have not seen an actuarial analysis this year, I think it estimated somewhere around 15 to 18,000 would enroll that were previously uninsured in last year's legislation as well. Again, I think the big difference in Washington is that those requirements, those mandates for providers to accept were not included. And yet, in Colorado, we've seen premiums go from 37th highest to 6th lowest in the 2 years since Washington State passed their public option, albeit very different. And so I think it is important to understand there are differences, but there are also other reforms that have sort of successfully changed those costs. And you know, we're at an all-time low when it comes to uninsured rates as well.
Not in a lot of parts of the state. What's good for Metro Colorado is not good for rural Colorado. The uninsured rate in the mountains and on the eastern plains and on the western slope is still significantly higher than the national average, and that's unacceptable.
So we're just going to do a few more questions. One is, if the public option is never implemented, what happens to the new government authority created to run the plan?
It goes dormant. It's not needed.
Good, quick answer. Okay, as it relates, we have one more follow-up on the rural issue. So Rep. Holtroff, again, big concern in rural hospitals is that there will be migration of healthcare customers to urban hospitals because of the disparity of costs created by public option when urban hospitals leverage their economies of scale and reduction of cost. My rural hospitals do not have the throughput.
Well, thanks for the question, Rep. Holtorf, and I look forward to chatting with you more about this on the floor. You know where to find me. The beauty of making it a Colorado option is that everybody's in the same boat. So when somebody who is insured by the Colorado option goes to a hospital, that they know they can get care there, and that hospital is guaranteed to get reimbursed for that care. So what the goal is of this bill is to ensure more people so that more people go to their local hospital or go to their local doctor. I don't think that's a controversial goal to have. How we get there obviously is controversial, and we've had a heated discussion, but by creating a statewide plan, you create a statewide network and people can go to the doctor or the hospital that's closest to them. And when more people are insured, more people feel more comfortable accessing care because they know they're not going to go bankrupt by doing it.
We have one final question, and I'd love
so I'll jump in on that if that's okay, Kristin. So this is actually why we're here today. It's the Common Sense Institute. And so common sense would say that, yes, you're right. For normal care, people will be able to get it where they need. But what has driven the increase in costs in rural parts of the state, high country, eastern plains, all over? And that is the increased distance to get to care, the age of those who need care, and the specialties that are simply not there. And that's really, when we take what the big puzzle is that we're looking at for healthcare, those are significant drivers. So when we say, because you have the Colorado option, suddenly you're going to be able to get the treatment you need in Haxton. Well, that may not be true because the market is not there to have the specialists there. And so I think that's a real caution in this, is that when we have a canard that, well, you're going to be able to get it because we've changed what the state does so that everybody can get better care. Some of that care is simply not going to be there. And I think that that's where we really need to dig in and say, there are other needs out of the healthcare puzzle. And this may address something, but at what cost? And then what can it not address? And those are some of those things that we can't just put all our eggs in one basket and then find out that the bottom falls out.
Well, I would like to continue. We still have more questions coming in, and I know that Leader McKean and Representative Roberts would probably be delighted to follow up with those individuals as well. They're very accessible. In addition, if you want to follow up with any of your questions with Common Sense Institute, we're happy to discuss them as well, but we're out of time, unfortunately. There were several other questions related to the Unemployment Insurance Trust Fund. Common Sense Institute has been monitoring this and following this. We released a robust report on where the UI fund currently stands, and I'd encourage you to visit our website as well. Joey, final thoughts?
No, I tell you, this is, I do a lot of these and I listen to a lot of these, and man, we could go for hours on this. I want to commend Representative Roberts and Representative McKean and Chris. Great job, guys. Enjoy working with you. Let's do it again next week.
Thank you to all of our panelists for being with us today.
Thank you so much. Yeah, thank you so much. And thank you. I just want to say
thank you guys.
Conversations, but thank you, Representative Roberts. Your staff has been very helpful and accommodating. It's been great to have conversations. So thank you.
Thank you all. So it's my pleasure now to turn it over to our next guest. We are going to be taking a deep dive on the state's budget and forecast. Luke Teater is a chief economist and deputy director of the Governor's Office of State Planning and Budgeting for the state of Colorado. Prior to joining OSPB, he worked as an economic consultant in Washington, D.C. and did community development in India. Luke, thank you for joining us. And I know that everybody on the call today will love to hear this deep dive of where we are with the state's fiscal outlook. So thank you for being with us.
Thank you, Kristin, and thank you for inviting me this morning. So I'm going to, as Kristin mentioned, I'm going to be talking about our economic and fiscal outlook for the state. This is going to be largely based on our recent economic forecast, which we just released and presented to the Joint Budget Committee on last Friday. So first of all, I'm going to start by talking about the economic outlook. And we're at a really unique and I would say unprecedented, if that word hadn't been so overused over the last year, at a really unique and unprecedented situation where our economic outlook has been improving relatively rapidly. And I think we have high confidence that we're going to see a lot of growth and a fairly strong rebound this year. So just as far as what has changed just over the last 3 months, and I'm using that as a reference point because that's when we did our prior economic forecast and revenue forecast. The major things that have changed are, first of all, COVID caseloads have been falling much faster than we expected at the time of our forecast in December. You might remember that at the state level, our peak in COVID cases came around like late November, early December. So in December, we were expecting those to remain very elevated throughout the winter, but instead they fell quickly and we were able to start rolling back public health restrictions, I think, quicker than expected. The other thing that's been improving is the outlook in the pace of vaccine distribution. We've done more than 2 million doses now in Colorado, and that's been going about as well and as smoothly as I think anyone could have expected in December when the first vaccines were getting approved. And then the last piece is the enormous amount of federal relief money that has been passed into law since December. We've had 2 bills. There was one that passed in late December that was about $900 billion, and then we just recently had the 1.8 or 1.9 billion or 1.8 or 1.9 trillion, I'm sorry, bill that passed just a few weeks ago. So all of this together means that forecasters are revising their expectations for this year and next upwards. What you can see in this graph is a comparison of forecasts of real GDP growth from a few major forecasters. The blue lines are from Goldman Sachs, the orange lines are from Wells Fargo, and the gray lines are from a Wall Street Journal survey of forecasters. And then the gold lines are from our OSPB forecast. The dotted lines here are everyone's projections from December. And then the solid lines are where their projections were just a few weeks ago when I accessed them in mid-March. So you can see that it's across the board, people have been revising their forecast up significantly. Everyone included here, and it's kind of generally becoming a consensus forecast that 2021, we will experience real GDP growth of probably in the range of 5 to maybe even 8% growth this year. And yes, that is coming from a lower level, but you can see even when indexed to 2019 in this graph, it's still a very high rate of growth. And just for context on that, if we experience 5% GDP growth this year, that's the highest growth rate we would have had since the early 80s in a single year. If it's towards the upper end of that range and gets up towards 8%, that would be the highest annual growth rate since the 1950s. So we're really in a very unique situation here. So just to talk a little bit more about some of the things that are factoring into these higher growth rates, some of the major contributors here. First of all, this federal aid that has been passed in recent months, between the two bills combined, it's more than 10% of state GDP that we expect is going to come through Colorado. You can see on the top line from each of these bullets, we're expecting the total money flowing to Colorado because of these bills to be about $41 billion. So really a very significant amount of government spending happening this year. You can see the major components of that too. I think the main things I want to highlight is that these bills were much more focused on relief than stimulus, to make a little bit of an arbitrary distinction there. But I think you see a lot of money in there for example, housing assistance and unemployment benefits, things that are more intended to kind of minimize the damage of the pandemic rather than to provide a long-term support for growth. One thing that I think is worth calling out specifically that kind of gets buried in this list of very large numbers is in the right column here and about midway down, we've got $2 billion expected to come to Colorado from the expansion of the child tax credit. So that is a big deal because most of the research that has come out on that estimates that could reduce child poverty by about 50%. So that's one of those things that kind of almost gets buried in this bill in some ways, but it is really a big deal for Colorado. So we can have high confidence in that we're going to see a strong year of economic rebounding and economic growth this year, because really some of the major economic factors are just in a very strong position. And so one of those I want to talk about first is aggregate household finances. So this graph, I think, is one of the most fascinating graphs to come out of the pandemic, in my mind at least, which is personal income. So all of these lines, this personal savings, personal income, and wages and salaries, are aggregate totals across the US economy. And these are changes as compared to February 2020. So you can see the light blue line in the middle, personal income, decreased from February 2020 to March 2020. But then as the first round of stimulus checks went out last spring, that increased quite a bit. And so they were on an annualized basis, 2 trillion more in April of 2020 than in February. And that has remained elevated throughout this pandemic recession, which is largely due to the significant amount of federal relief that has passed. That April peak that you see there is largely due to the stimulus checks that went out last April, and the January spike is largely due to the round of $600 checks that went out in January. But in between, the line remains elevated, and that's largely because of the other government spending. And again, there the main factor is unemployment insurance benefits. So again, it's remarkable and counterintuitive that through this severe recession that we've had the last year, that personal incomes have actually been higher than they were before the recession. The other thing is that you see personal savings have increased by an even larger amount. Now, the reason for that is that while personal incomes were going up, spending declined. And I think the reasons for that are obvious, is just that there were fewer ways that money could be spent. You know, if you were planning on sending your kids to summer camp last year, you didn't do that, and you saved that money instead. So personal savings have been above their pre-COVID levels in every month that we have data for so far. And we expect that to continue, at least until the economy is more open and the pandemic is contained. But when we look at that in aggregate, we estimate that there's been about $1.7 trillion in above trend personal savings accumulated since last spring. So if people start spending that down and kind of say, you know, if you're making your household financial decisions based on saying, I want my savings account at a certain level, and if it's above that, then I can spend more until it gets down to that. I don't think that's how people actually make their household financial decisions. But if we were to spend that down, that would be an extra 1.7 trillion that we would have flowing into the economy. And then the last thing I want to call out on this graph is wages and salaries. So you can see wages and salaries declined into April, but have been rising relatively slowly and steadily since then. This is aggregate wages and salaries paid throughout the economy. And in January, which we just got the February data this morning, and I haven't updated this yet, but in January was the first month where that exceeded the pre-pandemic level. So household finances are, in aggregate, looking very strong and are a major reason to be optimistic about the recovery this year. Another reason is that financial conditions are very supportive of recovery right now. So this graph shows the Goldman Sachs Financial Conditions Index, which is comprised of several financial indicators, equity prices, bond prices, and things like that. But the main thing to know looking at this is that lower numbers on this index means that financial conditions are more supportive of growth, while higher numbers here means that conditions are less supportive of growth. So what I draw your attention to is off to the right side of this, where you see we had a spike in early 2020, and you probably remember that in March as the stock market was falling by significant amounts. The Federal Reserve had to step in and support the bond markets. And that's really about where that spike is in 2020, off to the right side of this graph. But since then, financial conditions have eased significantly and become much more supportive of growth, to the extent where now in early 2021, we're looking at some of the most supportive financial conditions that we've seen. And then kind of the last couple of things I want to highlight about the current economic situation are, first of all, in the labor market, we are seeing a very disparate impact across industries and across workers. So we have broken out all of the industries for which we have employment data in Colorado by their wage level in this graph on the left to compare their employment against pre-pandemic levels. You can see that high wage industries, the gray bar here, have only had a slight decline from their February levels, and they've generally been on a consistent recovery since last April. By contrast, the low wage industries, like your leisure and hospitality industries, for example, the restaurants, the accommodations, experienced a very severe loss of employment in the spring. You see we're down by more than 25% there in April of last year. And recovered quite a bit, but is still down nearly 10%, and it remains vulnerable to changes in public health conditions. So I'm sure you can see those declines there in November and December. As we mentioned earlier, that was as we were tightening public health restrictions further in response to the rising COVID caseloads. So we are seeing very disparate impacts across industries, and a lot of job loss. We're still well below our pre-pandemic employment levels in total. But I think one reason to be relatively optimistic, or one signal that there might be some signs of a faster recovery in the labor market there, is that the job openings rate has been remarkably resilient. So this is the graph on the right. And the two parts I want to call your attention to here are the orange section of the graph, which is the Great Recession period. And what happened to the job openings rate then was that it fell quite significantly. There were just a lot fewer job openings in the economy. And then it took us years to get back to that pre-pandemic, or I'm sorry, the pre-Great Recession level. The blue section of the line off to the far right here is what has happened in this current recession. And you can see that we really haven't seen the kind of steady drop that we saw in the Great Recession. They've remained very elevated and remained not far below kind of the peak that we were at just before the pandemic. So I think that's one kind of hopeful sign for the recovery in the labor market that we'll see later this summer. But I should also clarify with that, we do expect that the recovery in the labor market is going to be slower than the recovery in the economy overall. So, and that's largely because so many of these job losses have been low wage workers in low wage industries. They kind of by definition don't contribute as much to aggregate output numbers like GDP. So I think we'll expect that we reach and exceed our pre-pandemic GDP numbers by the middle of the year. But I expect the labor market to lag behind that, and it'll take us longer there to get to our pre-pandemic unemployment numbers, for example. So to shift gears, the purpose, or the main purpose of our forecast, is to inform the legislature and the executive branch on how much tax revenue is going to be available, and let them know just what expectations they should have when they set the amount of money that they can spend in the state budget. And what we're seeing on the revenue side is that we've revised our state revenue forecast upwards again, and now we see the state revenues are approaching the Tabor cap. So this graph shows our general fund revenue forecast for the state with the Tabor surplus that we've had highlighted in yellow. You can see that we are currently forecasting that we remain below the Tabor cap, or to be more precise, I guess I should say that the referendum C cap, as revised by Senate Bill 17267 a couple years ago. But we're expecting it to remain below that level until FY23, at which point we'll have Tabor refunds again. But I want to clarify too that this is only a very minimal gap that we are currently expected to be below the Tabor cap. If you look at this box off to the right, our forecast is for state revenues to be about $83 million below the Tabor cap in fiscal year 22, which is the year that the legislature is currently setting the budget for. Now, within the context of just normal forecast error, that is a negligible amount. We could easily revise that just within a month. Within a month of new data, we could be off by that much. So I think for planning purposes, you have to assume that we are essentially right at the Tabor cap. And when setting the budget and passing legislation, we have to assume that there's a very good chance that we could end up above that by the time fiscal year 22 ends in about 15 months. The other thing to note here is that even for fiscal year 21, you see we're below the cap by about 600 million. And that seems like a lot, especially as compared to the 83 million that we're below by fiscal year 22. But there is a lot of uncertainty right now about how tax year 2020 final payments will come in. You know, we're in the middle of tax season, and some of these deadlines for individual payers were just extended into May. So there is a lot of uncertainty about exactly what the final revenue impact of tax year 2020 will be once those collections are made. And I think there is a possibility. I don't think it's a likelihood, but I think it is definitely a possibility that we could end up above the Tabor cap, even in the current fiscal year, which we're about 9 months into now. And so this chart just shows our changes to the revenue forecast since December. We're up by about 400 million in both the current year and the next year, and then about 600 million in fiscal year 23. These are smaller revisions on a percentage basis than what we made in our economic forecast. And part of that is due to some tax policy changes that were made in the federal relief bills that have passed in the last few months. So because Colorado conforms to the federal tax code on a rolling basis, when federal tax policy changes, our state tax policy changes as well. So you can see that because of these two recent federal bills, our state is going to have a couple of $100 million less revenue in each of the next couple of years, but resulting from that. By far the biggest component of this, and the about 75% of the totals that you see here, is due to the change made in HR 133 that passed Congress in December, that changed the business expense deductibility rules for people who receive PPP loans. So that's our revenue outlook. But you know, right now the budget committee is finalizing the state budget, and so I want to talk a little bit about what the implications of this are on our budgeting. So we are still looking at a structural deficit, especially as we reach this Tabor cap. What this slide shows is how much our general fund operating expenses grew on average through the last expansion. It was about 10 years there. We averaged about 6% growth in our operating budget per year. However, once we're at the Tabor cap, our general fund capacity will only be able to grow by roughly 3% a year. That's the amount allowed by population and inflation. And it'll actually be a little bit less than that probably, just because of growth in cash fund revenue, and that's a fee revenue to the state and how that affects our Tabor rebates. But we're looking at about 3%, I think is kind of a good agnostic projection for how much we might see our general fund capacity grow once we are at the Tabor cap. So what this chart is intended to show is that leaves about a 3% gap every year, even if our economy really booms and our revenues come in much higher than expected. All of that, or that extra money, will go back out the door as Tabor rebates, and so it doesn't actually help the state budget become more sustainable. We would still be looking at budget cuts of several $100 million per year, just to stay within that general fund budget capacity allowable under Tabor. So I think the main implication of this is that our office and the governor's office is encouraging a lot of this extra one-time money that we have available right now to be spent on one-time uses and to not build up our ongoing budget cost. We don't want to be starting up a lot of new programs that we're going to have to sustain year after year in a context where we're having to cut the budget around that. So this new money that we have, this forecast with the upward revisions to our revenue projections means that there's about $1 billion more available than would be needed to fully fund the governor's budget request, which was originally submitted in early November and then amended in January. So what our office is proposing for this new money is that a significant portion of it be used to pay down some of the state's long-term commitments and long-term liabilities. So for example, just looking at this chart that's got a couple of options for how we could do that. We could set aside roughly $1.4 billion this year to prepay the state's general fund contributions to PARA, and that would buy more budget capacity for the state over the next 5 years. This, and that would mitigate some of those consequences of the kind of 3% gap between base spending growth that we saw over the last 10 years and the 3% growth in budget capacity that we're expecting. So this has been confusing for a lot of people, so I want to try to explain it a little bit. This is a little bit like saying we're going to pay our known liabilities now while we know we have the money, rather than waiting and paying them on schedule when our budget will be tighter. So it's a little bit like making a larger down payment on a house and then having to pay less on the mortgage after that. It's just trying to use the cash that we have in hand to put ourselves in a better fiscal situation going forward. We're also proposing a large increase in state reserves. Last spring, when the pandemic began and the legislature and the governor set the fiscal year 21 budget for the year that we're in now, we had to cut about $3 billion from the state budget. And we had to spend down almost all of our reserves that we'd been carrying. So we are proposing a large increase in reserves just to help prepare for just the uncertainty and the revenue volatility that we know we will have just going forward into the future. And also just to buy up the reserves before we reach that kind of constraint of being up against the Tabor cap. And then this is just kind of an update for your interest. We in my office in OSPB have been obviously tracking a lot of our state emergency spending and our federal fund spending, and we will be reporting on that to the legislature just here next Monday, I believe.
And Luke, thank you. That last slide is perfect dovetail into some of the questions that our audience has. And the first of which it relates to kind of the federal money coming into Colorado. Attendee asks, where's the federal money going to go? Is that general budget money or what? Since money is fungible, will the money be used for things the average voter could not have anticipated or wanted? And I think you addressed some of that in your presentation, but could you maybe expand on that a little bit further as well?
Yeah, so that's a good question, because the answer is that it varies for many, many different revenue sources that we have, or many, many different types of federal funds we have coming in. So I mentioned the number of about $41 billion coming into the state. I should clarify that that is not coming to the state government. That's the amount that will flow into Colorado. So that includes things like the stimulus payments that are being direct deposited into people's bank accounts that don't touch the state budget or the state government in any way. I'm trying to remember specifically right now. I want to say it's about $6 billion of that 41 billion that is actually flowing into the state, or that will touch the budget in some way. Some of that is things like housing assistance dollars that will go towards the Department of Local Affairs and their housing assistance programs, and they will, there are kind of established channels for spending those. But I think the main question that is being asked is there flexible money? How can we shift money around? How will we shift money around? And that there's about $4 billion of very flexible money that is coming just in direct aid to the state government. And you might have heard, I believe it was just last week, the governor and the legislative leadership announced a listening tour just on how to best spend that money. So there definitely have not been any decisions made on that yet. But I think what we want to find out and what we're thinking through already is just what are the ways that can be spent to best support the economic recovery. Go ahead.
Just in relation to that, so we mentioned in this presentation, there was some discussion at the panel level on the Unemployment Insurance Trust Fund. And I noticed that that wasn't part of your presentation related to surplus money and hope maybe putting some money towards that. Two questions. First one, can federal dollars be used, the stimulus dollars be used to replenish the UI Trust Fund? Secondly, do you envision the governor helping use some of these excess dollars to replenish the fund as well?
Yeah, and again, that's a good question. So to the first part about is it possible to use it for that? We don't have the final guidance from the federal government on exactly what the allowable uses of this will be. We're going to be receiving that hopefully quickly as we do this listening tour over the next few weeks. But my expectation and assumption is that it probably would be allowable to use that to backfill the UI Trust Fund. That is an idea that has already been broached within the governor's office and in discussions with the legislature around just can we pay down some of that and reduce the fee increases, the UI tax increases that are coming from that onto businesses. Definitely no decisions have been made yet there. I think that's going to kind of roll in with the listening tour and kind of where the state priorities end up being as we move forward with that. But my expectation is that yes, that's probably an option, and that's something that is being considered.
Chris, did you want to add anything to that? I know that you and Common Sense Institute, we've done a lot of work specifically around the UI Trust Fund and the looming tax increase that will be on the back of business. Did you want to speak to it?
I think I appreciated Luke's remarks, and I think getting more guidance on that would be critical, and just sort of echo conversations we had in the panel that the projected increase will likely be very significant for years to come. And as the trust fund is taking on federal loans right now, it's not just a matter of replenishing, but it's also a matter of, preventing further loan increases and sort of taking on a much larger burden. But, very much we saw the update this round, and we think that, the years outside the forecast would actually be even higher. So one consideration, but it has a real impact, and I think I'm encouraged to hear that it's being considered.
Chris, correct me if I'm wrong, but Colorado is one of only 17 states in the nation currently taking federal loans to keep our UI trust fund afloat. Is that correct?
Last we checked, Colorado, ranked 9th in terms of highest loans per resident, if you adjust loans per Coloradan. So top 10 in terms of the magnitude of those loans being taken out currently to fund the state's benefits. So again, stands out in some ways relative to other states.
Last question, Luke, and this relates back to the slide you presented around savings. Is this an overall average, or are some people saving a lot while many people are losing savings? I know that was a slide for the nation. Is there anything else Colorado specific you have related to savings as well?
So first of all, it's an astute question because yes, these are definitely aggregates that we are showing, and there is a wide disparity there in terms of how much people are saving, just by income levels or by what industry you're working in, and we don't have a lot of visibility into that, especially at the state level. One of I think kind of the best resources that we have is there was a report put out, I think it was 2 or 3 months ago now, that from JP Morgan Chase, looking at checking and savings account balances by income quartile. And they found that I believe the data that they were using was through October. So through October, account balances across all income levels were up and above their pre-pandemic levels. But what they found were that those extra savings were being spent down for the low income quartiles, like the bottom 20% and the 20 to 40% range. They were spending those down, while for the higher income quartiles, they were basically just remaining high and in some cases growing. So I think that the spend down there kind of coincided with the end of the additional $600 a week federal unemployment benefit. That ended at the end of July, and we didn't have that through about the end of the year, but now that's back up to $300. And so definitely, I think a lot of these low-income workers who have been unemployed are now having more unemployment income over the last couple of months than they had through the fall and early winter.
Well, thank you, Luke. We really appreciate you being with us. Thank you for all the great work that you do down at the Capitol, at the OSPB. Really appreciate it. That will conclude our program today. If you'd like to subscribe to our biweekly newsletter to stay on top of the latest public policy issues facing you, please subscribe at commonsenseinstituteco.org. Thanks again for joining us and have a great day.